Good morning. It's Monday, December 2nd, 2024. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. As a reminder, if there's something that I have to say or communicate to you intra-week, we'll put it on either LinkedIn, Herb Morgan, or on X at Herb W. Morgan. This presentation has been prepared by Cantor Fitzgerald Investment Advisors. We are an SEC registered investment advisor. It is designed to be used by both investors and financial advisors, but each are expected to make their own investment decisions. Nothing contained in the presentation should be treated as investment advice, tax advice, or a recommendation for the purchase or sale of any securities, purely for informational purposes. The views expressed herein are my views and mine alone. They may differ from the views of CFIA's parent affiliates or other portfolio managers at CFIA. Well, the rally continues. S&P 500 up 1% last week. Mid and small cap stocks participated strongly. The only thing not up, as you can see, was emerging market stocks down there a little bit. This is mostly on tariff-related trade threats from incoming President Trump, number 47. Most negatively impacted in the group would be countries, specifically China, Vietnam, another big component to the emerging market index would be impacted potentially as well. We got some relief in interest rates as the U.S. aggregate bond index traded significantly higher last week, almost 1.4%. The long-dated treasuries up almost 4% on the week as the 10-year yield retreated from about 4.5 down to the sub-4 range later in the week. Let's start with the economic data. We got plenty of it in the shortened trading week. Even though it was a shortened trading week, we got a lot of economic data last week. Let's start with home prices. FHFA in September said the home price index was up 0.7%. That was more than double the expectation of 0.3%. And home prices by this measure up 4.4 on a year-over-year basis. The next day, of course, we got the Case-Shiller home price index. They say homes were up about 0.2% for the month and about 4.6% year-over-year basis. So very similar readings of the two. Regional Fed survey, Philly Fed Business Outlook survey minus 5.5. You see that over here on the right. The estimate there was higher, and the prior month was higher. You can see here, these are like these long periods of expansion, right? This is the COVID crisis and the shutdown. This is the reopening, and we've just had very, very poor manufacturing ever since the reopening. And then recently, we've just sort of had some ups and downs. I think part of the incoming administration's policy is to focus on manufacturing. Even though manufacturing is 15% of the U.S. economy, it's 15% is very, very, of course, significant. Back to residential real estate, new home sales took a little bit of a dive there, as you can see. Came in at 610,000 annualized. The estimate was significantly higher than that, 725,000. But we attribute all of this to the two hurricanes, Helene and Milton, because the southeast part of the country was down about 28% and really accounted for almost all of that. Pending home sales were up 0.2%. These are existing homes that are pending for resale. The estimate was they would be down 2%. On a year-over-year basis, pending home sales actually up 6.5%. What happened was in the month of October, there was a blip downward in mortgage rates. It was the lowest level in 2 years, and that really pulled buyers out and drove pending sales to a 7-month high on that index. Consumers also starting to get a little more confident. You can see that coming back. Over here on the right, 111.7, a little above the estimate of 111, up from 108.7 or 109 in October. This survey was post-election. So I think, with a more pro-growth, pro-business oriented administration and focus on deregulation, I think at least promises to handle some of the inflationary concerns that consumers have, has led to a little uptick in confidence. If the new administration delivers, well, then we'll see that continue to go higher. If they don't, we'll probably see it turn a little bit lower. Third quarter GDP came in right in line with where it's been. It was 2.8%. It was 2.8% of the preliminary report as well. No change there. That's solid. Interestingly, incoming U.S. Treasury Secretary Scott Bessent has been very advocating for targeting GDP now at 3% plus. Now, with a level of debt load that the U.S. has, if we can get a non-inflationary 3% growth, that would go a long way over time to taking the debt as a percentage of GDP to more reasonable levels. The problem we have, though, with trying to target higher growth levels is that we still have high inflation levels. And we got the October core PCE inflation reading. As a reminder, core PCE inflation is the metric that's used by the Federal Reserve to determine whether or not it is meeting its statutory mandate of price stability. It defines it itself as 2% core PCE inflation. Obviously, at 2.8%, we're well above that. And we had been in a very nice downtrend, and we may still well be in that downtrend, but we've been stuck here for a period of time now, significantly above the 2% target. And this was a little disappointment. The estimate was for 2.7 in September. We came in, or excuse me, the estimate was 2.8. We came in at 2.8, but that was higher than the 2.7% number for the month of September. We also got minutes last week from the Federal Open Market Committee's meeting that took place November 6th and 7th, where they did cut interest rates another 25 basis points. The highlights, I read them for you. They say their inflation outlook is little changed, and that outlook is that inflation is coming down naturally, that there is a slowdown in growth coming and a slowdown in employment coming. But I feel that the participants are really starting to doubt that outlook, and they're sort of maybe kicking the can down the road, hoping the market will come to their view, but slowly coming to the realization that we are not getting down towards that 2% inflation. That core PCE reading from last week obviously came out after they had their meeting on November 6th and 7th. They say that downside risks to employment have decreased. In other words, they said, hey, we're concerned about employment, so we're going to start cutting interest rates sooner rather than later. But that concern of employment now has decreased. In other words, we were a little too soon and maybe even a little bit incorrect. They do say, however, it is still appropriate to continue to move gradually towards a more neutral policy stance, basically saying that the current level of the federal funds rate is restrictive, and they think it's going to bring down inflation. They suggest more cuts will come again in either December or January, but not both. Prior to that, I think the market was expecting 25 basis points in both December and January. Now it appears that there'll be one or the other. And they cited, well, we know the growth in the United States is good, the economy, the employment situation, everything in the United States is great. So we looked at global growth has weakened, and it's an accurate statement. Around the world, the U.S. is an outlier in its ability to continue to grow. Central banks around the world cutting rates, particularly look at the European Central Bank. And so they've cited that as possibly bringing down the inflation issue. And they may be grasping a little bit at straws here to sort of justify their prior actions. But they say in the bottom line, the risk to their inflation outlook is little changed, but they see the possibility of sudden disruptions in global supply chains due to geopolitical developments. In other words, the threatened tariffs of the president, a larger than anticipated easing in financial conditions, stronger than expected consumption, that's the U.S., more persistent shelter price increases. Services and shelter prices are what's keeping inflation stubbornly high, or perhaps they say the cost of insurance might continue to go higher. And therefore, we now see that the odds of a Fed rate cut this month, December 18th, sitting at about 65%. Durable goods orders came in for October up 0.2, a little less than expected, better than the negative number in September. These sort of soft or muted numbers were likely reflected pre-election uncertainty, and the majority of economists expect those numbers to pick up significantly November, December, probably more December, as the incoming administration is seen as more potentially growth. Personal income up 0.6, strong. Personal spending up 0.4, also strong. The consumer, who is king in our economy, remains very, very healthy. Weekly initial claims for unemployment came in at 213, right in line with the 215 estimate. Continuing claims 1.9, right along with the estimate of 1.9. You can see over here a little blip related to the hurricane where we got above 250. Wow, I've always said that anything below 300 is a strong labor market, and we just keep bouncing along the bottom here at about 200 to 225,000 every single week. Lots of economic data this week and lots of important economic data. We're going to start this morning with the two manufacturing PMIs. Both, as you can see, both S&P and ISM are expected to be below 50. That means contraction. And I think this is a big, bone of contention of the incoming administration. They want to be dominant and relevant in manufacturing. And we have been, ever since COVID, just sort of bumping below this 50 level. Manufacturing represents about 15% of the U.S. economy. Construction spending expected to be up 0.2. Job openings, 7.47 million is expected. This is down from the 12 million we had coming out of the pandemic. Getting closer to equilibrium, but job openings still exceed the number of people unemployed or loosely employed, underemployed. Ward's vehicle sales on Tuesday expected to be at an annualized pace of 16 million for the month of November. The two employment reports, Wednesday and Friday, ADP thinks the estimate is 158,000 jobs. On Friday, the BLS report, 200,000 jobs and a 4.1% unemployment. We get the two services PMIs, final readings for November on Wednesday, both expected to be solidly above 50, even above 55, which shows a very strong and resilient economy. Factory orders, durable goods, the beige book for the upcoming December Fed meeting also will be released on Wednesday. We'll be sure to be looking at that. Trade deficit of 75 billion expected to be announced on Thursday for the month of October, 215,000 in weekly unemployment claims. We'll round it all out with Michigan's sentiment on Friday. That looks like the Conference Board, likely to increase. And then consumer credit expected to come in at about 10 billion. We are available on all of your podcast formats as an audio podcast, but also on the YouTube channel with the graphs and charts. So the best place to get us is on the YouTube channel. You can search by Herb Morgan. You can search by Slaying Bulls and Bears. We're trying to make the complex and complicated simple and sensical. Thank you. I'll be back to you again in 1 week.